This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
All right, however, that's one way he's asked you to get growth. The other way is very, very easy arithmetic, but he could ask you for a bit of a chat about it. And the point is this: why do dividends grow? It's all right saying dividends growing at 4%, 5%, whatever, but why? Dividends don't just sit there and grow like a plant, you know. Why should your dividends grow? Well, if you ignore inflation, and you would here, if there's no inflation, surely the only way that dividends can keep growing is if profits keep growing. Would you agree? All right, year by year, I mean, obviously, this year I might pay a low dividend, next year a big dividend, I could change my policy. But the only way in the long term you can keep growing dividends is if you keep growing profits. Does that make sense? How do you keep growing profits? Well, of course, there are all sorts of ways in the short term. Cut costs and profit goes up, you know. But in the long term, you can't keep cutting costs forever, you know. In the long term, the only way you can keep profits growing is by keep expanding the company. Still with me? And how can you keep expanding the company? The only way you can keep expanding is by keep investing more, which means keep raising more money. Still there? Well, in the short term, lots of ways you could get more money. Borrow money from the bank, expand. But the only way you can keep raising money year after year after year and keep expanding is by using retained earnings. That if instead of paying all your earnings out as dividend, if you only pay part of your earnings as dividend, the rest of it remains in the company, invest more, expand, more profit, and so on. Am I making sense there? And he can ask you to use that principle. If you look on page 94, I have a tiny little illustration. Now, the reason it's in a box, you would never be asked to do what we're about to do, never. But simply because he could ask you to write about what I've just said. This doesn't take a minute, but I think explains, I hope explains basically what I've said. If you just look at that, it won't take a minute. As I say, you will never be asked to do this. But do see the sense of it, then you could write a few lines if it was asked. Company A is earning $100 and it's all going as dividend. So in the first year, year 0, their earnings is 100, it's all going as dividend, fine. The dividend obviously is 100. Well, because that company hasn't retained any money, they're not able to expand. And so, you'll be expecting the earnings to stay at 100. Agreed? Again, in real life, there are a million reasons why it might change, but we're after what you're expecting. And if the company's no bigger, you won't be expecting the earnings to be different. True? And so, you'll be expecting the dividend to stay at 100 and so on. There's no reason for you to expect it to grow. But look at example Company B. Company B, they're earning 100 as well. You don't need to write this down. You've got it. But their earnings are 100. But they're deciding they'll only distribute 40% as dividend. So, they're going to retain 60%. The dividend, therefore, would only be 40. Yep. But what's going to happen next year? surely you're going to expect that the existing operations will still earn you 100. True? But if this company retained 60, presumably the company has invested that 60 in new machines or whatever, and you'll be expecting, therefore, that in future the profit will increase. And it says in this question, or in this illustration, that they're able to reinvest the retentions to earn 10% a year. So surely, if they retain 60 at time 0, if they're investing at 10%, you're going to be expecting from then on that earnings will go up to 106 a year. Am I making sense again? And if you're expecting the earnings to be 106, well, assuming they keep the same retention policy, they're going to retain again 60%, which is what, 63.6. Distribute 40%. Well, again, because of higher profits, higher dividend, the dividend goes up, I should cheat here, 42.4. And you're going to expect that to keep happening. But, you know, you're expecting in time 2, they're already earning now 106 a year. But because in the second year they've retained more, if that's going to be invested at 10%, from then on, you're going to expect the earnings to be 6.36 higher. Yep. And assuming they still retain 60%, distribute 40%. Well, I'm not going to waste time checking it. It was right. 60% is 67.416. The dividend, 44.944. And I mean, by all means, carry it on a third year or fourth year. Try it at home if you're not convinced. But the point is, remember, it's only expectations. I know profits can change for a million reasons. But, you know, you're not expecting strange things, you know. But if this company is retaining, you will expect the earnings to increase and therefore the dividend to increase. And on this illustration, how much is the dividend increasing? It went up 2.4 on 40. 2.4 on 40 is, it went up 6%. Check it yourself at home if you want. But the second year, it went up 2.5944 or something on 42.4. Check it yourself, but again, it's 6%. That you'll be expecting dividends to increase at 6% a year. But why? The reason you'll be expecting it is because this company's retaining 60% every year. And they're managing to invest it at 10% every year. All right? Telephone Vita. Well, although I wanted to illustrate that, as I say, because he just could ask you, not for many marks, but 3-4 marks, to explain what we call retentionary growth. As far as the numbers are concerned, well, if I told you what the retention policy is, they're retaining 60%. If I told you what return the company got when they invested it, 10%, then in fact you can write the growth straight down. There is a formula. It's given you on the formula sheet. G is B times R. What does he call it on the formula sheet? Gordon's growth approximation. It's the easiest formula you'll ever see. But, of course, yet again, it's remembering what the symbols are. G is the growth per annum, which is what we're after. As I hope the illustration made clear, it depends on how much you're retaining and how you're investing it. Well, B is the proportion retained R is the return we're getting on reinvestment. The return the company's getting. And so you can see immediately for this example we just looked at, the company's retaining 0.6, 60%. Sorry, I'm trying to get my mouse. It said the company was reinvesting that money at 10%. Automatically, the profits and therefore the dividends, you'll be expecting them to grow at 6%. Okay? So again, I'm sorry about that chat. If it's just the numbers, obviously, it's trivial. If he tells you the growth rate, you should stick it in the formula, we've got it. But if he doesn't tell it you, but he does tell you what we're retaining and what we're reinvesting at, the arithmetic, I hope, is trivial. But, you know, take the time, look back at the illustration later and make sure you're clear about the idea of it. Because he could ask 3-4 marks just to explain what we mean by retentionary growth. You know, because that's why you'll be expecting growth. Okay? All right, so otherwise I hope they're easy. Can you do, example 5 and example 6? I think example 5's a joke. But make sure when you've done example 5, check the screen in case you didn't find it funny and got it wrong. So to example 5, check the screen. If you don't agree, obviously ask me. If you are happy, can you do example 6? Which isn't hard, but you'll have to think slightly longer. Okay? I'll say, though it should be trivial, please do check example 5. Obviously, anybody can make a silly mistake. Assuming it is right, have a go at example 6. All right, can we check? I think it's time to do A and B. C, we'll deal with together, all right? But can we check? Apart from Vita, of course, hasn't had time to do anything. Nobody asked me, so I assume everybody got number 5 right. That was trivial. Retain 40%, reinvest at 20. Dividends, therefore, you'll be expecting to grow at 8%. Question 6, I thought was quite nice. It's not hard, but especially obviously in an exam when there's lots of information, I think you'd agree it will take you a few minutes to sort it out. Yeah. But here I had told you that currently earnings per share are 32. The current dividend is 20. So we're retaining 12. And therefore the retention rate this year, you're retaining 12 out of 32. Do you all agree? 37.5%? Hello? And we've no choice but to assume that they intend to keep to the same retention policy. So B, 37.5. The return on reinvestment, you were told, was 18. And therefore, you'll be expecting growth. B times R, I think my arithmetic's right, 6.75. Okay? Everybody? Well, I had already said, once you've got the growth rate, whether he wanted it this way, whether it was past dividends you'd looked at, or whether he gave it to you, once you've got the growth rate, the cost of equity is simply using the formula. So the cost of equity formula, P naught 1 plus G, what am I talking about? D naught 1 plus G over P naught plus G. You better check me. D naught, the current dividend is 20. The growth rate, 6.75%. The market value, 280. Plus G, the rate of growth. I get a cost of equity, therefore, of am I right, please? I get 0.14375 or 14.375%. If you've rounded it, fine, usually 2 decimal places, but I don't care. Is everybody clear there? Now, I'll look at part C in a minute, but the important bit for what we're talking about is part B. Yeah? I know I've said, but I say again. You're always going to need to do that. G will either be given. If it's not given, you'll either be given past dividends, you did what we did before, or you'd be given RB information, as you were here. Part C is interesting. I wonder if anybody's spotted it. It's less likely, but it certainly has been asked. Sorry, you are all happy about B, though, are you? It's B that's important in terms of cost of capital. Part C, though, says, estimate the market value per share in 2 years' time. Think about this. But then, even though it's not often asked, I would actually learn it. The market value, hello, the market value, I said ages ago, is the present value of future dividends discounted at the required return. Yep, that's where it came from. And although it's something you'd never do, you could write down a list of dividends. You know, this year was 20, so next year is 20 plus 1 year's growth, the year after is 20 plus 2 years' growth, and so on. And the market value is the present value of those at the required return. Well, the market value is always the present value of dividends. If we came back in 2 years' time, think about this. I'm not going to write on the screen, but we're only talking about expectations. In 2 years' time, what dividends would you expect? You'd be expecting exactly the same dividends you're expecting now, except in 2 years' time, they'll all be 6.75% higher for 2 years. Yeah? Well, think about it. It is a fact. If dividends were going up at, say, 5% a year, because the market value is always the present value of dividends, if the dividends are going up at 5% a year, then in theory, the market value will go up at 5% a year as well. Think about that. It's only expectations. In real life, obviously, a million things can affect things. But if you expect the dividends to increase at 6.75, you will be expecting the market value to increase at 6.75% a year as well. If you're not convinced, shout, and I'll write a couple of figures on the screen. Will you accept that, Ilse? Ines? Yeah? And so it's now easy. What do you expect the market value will be in 2 years' time? At the moment, what is it? It's $2.80. If dividends are growing at 6.75 a year, market value will grow at that much. To grow it, multiply by 1 plus G each year for 2 years. You'd be expecting the market value to have grown to the nearest cent, I get $3.19. We better check it. Okay? Labby, labby, labby. Okay, Vita? All right, well, as I've said, today I'm much more concerned with the cost of capital itself. So what really bothers me is that 14.375. But it would have been silly to waste it. He's occasionally put that, have that little, what you might call, trick lying around. On its own, if you've understood me, that is easy. If anybody's keeping their mouth shut and is wondering where the hell it came from, ask me after and I'll sort of convince you. But I don't think there's much to remember there. To be safe, I would remember that you'll expect market value to increase at the same rate as you'll expect dividends to increase. All right? And in fact, it is logical, another way of looking at it. If the company keeps reinvesting, think about that example I had before. The profits will be going up by 6.75%. If the company's making more and more profit, you'll be expecting the value to go up and up and up. Okay? All right. However, as far as cost of capital is concerned, for equity, that is everything. It's not hard. It's only formulae. It's practice. That's everything you can ask, for the moment anyway, on cost of equity. It's using the formula, D01 plus G over P0 plus G, coupled with occasionally having you estimate growth. Okay?